Hello, I'm Hickey from interest.co.nz and welcome to another in our series of the top 10 charts of 2009 that we're running over this summer. These charts will hopefully explain what's happening in the economy and give us an idea of what's happening next, and try and explain some of the drivers that are moving both our politicians and our policymakers. This chart here shows you the economy split into two halves, if you like. Firstly, the tradable sector, which includes all our exporters and those companies that compete with imports. So you might have someone who's making some sort of manufactured good that, even though it's sold in New Zealand, is competing against other imports. Or you might just have an exporter. And that's the first half of the economy, the tradable sector. And then there's the non-tradable sector. And that includes parts of the economy that don't compete with the rest of the world. For example, banking, insurance, telecommunications, government itself. These things don't compete with the rest of the world. Realistically, we can't go and get our teeth done at an overseas company, or we can't, for example, order our telecommunications or banking services from someone overseas. We have to buy it from someone here in New Zealand. And what you can see is that between 1990 and about 2005, those two sectors pretty much grew in tandem. They moved up at the same sort of rate in terms of real GDP. But then something happened in about 2003, 2004. Well, we know what happened. The housing boom happened. Between 2002 and 2007, house prices virtually doubled in New Zealand. And we got tied up in a boom. We decided that the way to invest was to invest in property. And that fostered all sorts of non-tradable activity in what I call the services sector. That includes real estate services, banking services, and the likes. They expanded very fast between 2004 and 2007 or so. And you can see it came at the expense of the tradable sector, our exporters and the like, partly because our interest rates had to be pushed up by the Reserve Bank, and that pushed up our currency, which made life difficult for exporters, but also because they were starved of capital that was instead pumped into the housing market. And you can see here this divergence between the tradable sector and the non-tradable sector has really sharpened off in the last couple of years. This is a real worry for New Zealand. This is the signal that we have an unbalanced economy, one that in the long run won't be able to sustain us. We need that tradable sector to be producing goods and services that can help us service our international debts. And a large chunk of the non-tradable sector is funded by foreign borrowing. This is something we just can't sustain and has to be turned around in the way that we tax ourselves, the way we organise the economy, the way the government operates. If it doesn't change, that gap will continue to widen and essentially the economy will eat itself. I'm Hickey. That was another in our series of the summer charts of 2009.